The collar. A collar is a hedging strategy that involves holding the underlying stock, buying a put option for protection, and selling a call option to reduce the cost of the hedge. For every 100 underlying shares, we sell one call option and buy one put option with the same expiration. This means that we have combined a protective put with a covered call. Building a collar involves buying 100 underlying shares, buying one put option, and selling one call option with a higher strike. The two options must have the same expiration date. The trader who uses a collar holds the stock but fears a market correction and wants to cover his position. Selling the call option with a higher strike reduces the cost of the strategy. This strategy's ratio is 100 in the underlying stock and 1-for-1 in the options. The maximum gain is represented by the difference between the strike of the call option and the purchase price of the stock less the net premium paid, or plus the net premium received. The maximum loss is limited to the difference between the purchase price of the stock and the strike price of the put option, less the net premium received, or plus the net premium paid. The break-even price is the purchase price of the stock plus the net premium paid, or less the net premium received. Consider the payoff diagram. A represents the strike of the put option purchased, and B represents the strike of the call option sold. B is higher than A. The break-even is the point between A and B. If at expiration the price of the stock is higher than the break-even, a limited profit will be realized. On the other hand, if the price of the stock is below the break-even at expiration, a limited loss will be incurred. If the price of the stock is higher than the strike of the call option sold, the call option will be in the money, and the put option will be out of the money. In a collar strategy, the maximum loss is incurred when the price of the stock is less than A. Ideally, the price of the stock will be close to or higher than B at expiration. The profit on the strategy is the difference between the break-even and B. On the other hand, the strategy features limited risk. As a trader, you should be looking for transactions with the lowest risk and the highest returns. Now let's take a look at an example on WestJet Airlines, ticker symbol WJA. First, you buy 100 shares at a price of $25.16 each. Then you sell the call option with a strike of $27, collecting a premium of $1.65. Lastly, you buy the put option with a strike of $23, paying a premium of 25 cents. The spread this creates represents a cost of $23.76. Looking at the risk analysis, the total cost is $2,376. The maximum gain is $324, i.e. the difference between $27 and $25.16, plus the $1.40 net premium received from the two options. The maximum loss is $76, i.e. the difference between $25.16 and $23 less the $1.40 net premium received from the two options. The break-even is $23.76, and the options have a term of 70 days. Calculating profits and losses on this strategy is quite simple. Just calculate each leg separately and determine the net result. The first column shows a simulation of share prices on the expiration date. If the share price is below $23, the call option will be out of the money, and the put option will be in the money. The net loss will then be the difference between the share price at expiration and the purchase price of the shares, plus the value of the put option, plus the credit related to the strategy, i.e. a net loss of 76 cents. If the share price falls between $23 and $27, the two options are out of the money, and the net profit or loss is simply the difference between the share price at expiration and the purchase price of the stock, plus the credit related to the strategy. The break-even is then $23.76, the initial cost of the strategy. If the share price is above $27, the put option will then be out of the money, and the call option will be in the money. The net profit will be then the difference between the share price at expiration and the purchase price of the stock, less the value of the call option, plus the strategy's credit, for a net profit of $3.24.